Pankaj Pandey, Head of Research at ICICIdirect.com as well, joins us on the show. Pankaj, hi, morning. Firstly, your expectations from the policy. Would it be a status quo, or do you think Raghuram Rajan could throw us a surprise today?
Well, we would like to believe that there will be no hikes, but at the same time, we would expect a more hawkish kind of a commentary, especially from the fact that the monsoon last year has been quite kind in terms of both supporting economic growth and as well as from an inflation perspective. But probably this year it might pose challenges on that front, so we would expect a more kind of a hawkish kind of a commentary, though no changes on the rate side.
Pankaj, the big star sector yesterday was cement. Now what's going on in cement stocks? Cement stocks have been on a tear. Cement is an expensive sector, and on ground there is still no evidence that cement demand is back. In fact, according to most industry experts, Indian cement industry is still suffering with overcapacity. So what is driving so much of price optimism in cement as a group?
See, cement, if you look at Nikunj, is a local commodity, so it is really not influenced by what happens globally. And domestically, if you look at things have not been good on the volume front. If you look at volume growth has been about 1% odd. But having said that, if you look at the industry has got pricing power. So what we are expecting is about 4.5% kind of a volume growth and plus about 1.5% kind of a pricing growth. So that will take about 6% kind of an industry growth rate going forward. But there are certain players like Ultratech or for that matter Shree Cement which will grow better than the industry at 7 to 8% because of the capacity expansion which they have done. I think the good part is that the P&L, the balance sheet is very healthy for most of the cement companies. So you don't see leverage in most of the balance sheets. Although the P&L is volatile. But I think market is taking comfort from the fact that this is a better infra place to actually look at in case if we get a strong mandate because the industry has got all the right things in its place. So in that sense, this is one of the key beneficiaries compared to a leverage player wherein people are still sort of trying to figure out as to what kind of debt reduction might happen and what would be the balance asset which will be there in the company post any asset sale which happens. So from that perspective, I think cement is the best play in the economic recovery. If some has to look at, yes, you're right that the sector is quite expensive, but we have seen that the earnings can actually grow quite substantially because last quarter, if you look at, there has been about 30% kind of a decline in EBITDA per ton. So we are looking at it from a really low base. So that can also improve going forward in case if we see economic revival and industry doing well on both pricing and volume front.
Okay. Pankaj, with all the hum and drum about China, given that China clearly is still occupying the center stage, it is still a big wrinkle when it comes to global growth. Why is a stock like Hindalco doing well? Novelis, that business is still shaky. India demand for aluminum is not back, but looks like markets are in a mood to ignore all the core fundamentals. Why is Hindalco sitting at 140 rupees?
I think, Nikunj, again, probably we might see some kind of a boost to the economy on the China front, though again it is sort of very subjective in nature. But having said that, steel is a sort of a global commodity, and which is why we really can't take a call much on the pricing side because a lot of global players, especially China, has got 30 to 40% kind of a contribution in terms of demand and supply. So from that perspective, I think the market discovery for these prices is still sort of skewed towards China. But having said that, on a company-specific basis, we have a hold rating on the stock because we don't believe that the return ratios of the company are expected to improve or go in double digits. We don't expect much of a significant debt reduction to happen. So from that perspective, we would not be positive on this entire metal pack, including Hindalco. However, we like a stock like NMDC, which is where we would expect a decent volume growth, 30 million tons this year, 32 next year, and trading at about 11 times a 515 basis. So this is what we would like. But overall, we have a negative bias on the metal as a pack.
Pankaj, give me a large cap stock which after the recent run up is still looking cheap, where valuations are looking attractive, and that large cap stock has potential to give a 15-20% return in next 1 year.
Stocks which we like within the large caps, one of them has been Bajaj Auto. It has been part of our yearly pick. We have a target price of 2,450. The stock is available at about 14 times forward basis. The company has got one of the best margins in the industry. I think on the volume side, the company is struggling, but we would expect that the product mix would improve on the export front, and plus, if there is a urban demand recovery, this company would be a beneficiary of that. So this is one particular stock which we like. Besides we also like Titan Industries with a target price of over 285. Again, we would believe that the government would relax certain controls and that will benefit the company. So these are the two picks which I would have.
So let's take those stocks one by one. Why do you like Bajaj Auto? Because Bajaj Auto is a big exporter. If rupee appreciates, 40% of the business for Bajaj Auto, which is export dominated, could come under pressure. Some of the major markets where they export, Nigeria, Egypt, they are not growing. See, they are losing market share in the domestic market. So on all parameters, according to me, Bajaj Auto should be a sell, not a buy.
So Nikunj, if you look at, like I said, on the export front, the product mix is expected to improve. So earlier they were selling more of boxers. You would expect them to sell more of pulsars, and which would lead to better margins. Also on the domestic front, if you look at, the volumes have been nearly stagnant for the past 4 or 5 years. But if you look at EBITDA per vehicle has actually improved for this particular company. So from that perspective, they are efficient cost managers. So as and when, in case if there is a urban demand recovery, if it happens, I think this company will be a beneficiary of that. And I think compared to a number of other players, auto is one of the best sectors which one can look at from a valuation perspective. The stock is available at 14 times. So from that perspective, I don't think it should be sell. In fact, we have a positive bias on the stock. It is part of our portfolio, and we would like to believe that the stock would deliver a good set of good returns from current levels.
Give me a stock where you are simply advising your clients that they should buy that stock for a 15-20% upside. You're not advising your clients to buy that stock because fundamentals are looking strong, but you are of the view that momentum is strong.
From a momentum perspective, we like Oberoi. Again, we're not expecting much of an improvement to happen anytime soon. But what has happened is that the company has taken care of its growth prospect beyond 5 years. I think that was the key concern. So we would expect that the momentum would be there in interest rate sensitive stocks, and Oberoi is one of them. So we would expect the stock to deliver about to reach levels like 280. So this is what we would prefer at current levels.